Tristan Taylor. Oh, so we have 6 people. You guys visit the trees. I can't see. That's the thing. You like, how are you?
I'm great, how are you?
We're good. So we're learning about mutual funds. I'm Reed Razor. I own Omnibus Financial and Castle. I guess I should tell you all that. I do financial advising for high net worth, ultra high net worth, people all over the country. So I'm fully licensed in 37 and 66. And I'm here to talk to you about mutual funds. So do you have questions? Do you know what a mutual fund is? Maybe no. No? Vaguely. You know what an equity is? No? You don't know what stock is? So stock is an equity? Okay. You just learned, I just told you to learn. So a mutual fund, very, very broadly, is it's a company that pools investors' money. Usually they have very, very low minimums, if minimums at all. So if you look at like an American fund, American Growth Funds is a mutual fund. You can get started in there for like, I think the minimum is like $200 or $100. I can't remember the minimum investment. So anyone can do it. If they pool the money into a company that tracks a certain index, usually the S&P 500, it could be the Russell 3000 or 1000 or the Dow Jones. It even could be a bond market if you're not as aggressive and don't want those equity, which are stocks, that risk. So stocks are the most aggressive thing. Bonds are very not aggressive and guaranteed typically depending on the ratings. So mutual fund is a large company that pools all the investors' money, and it's only traded once a day, and that's after market closes. So they take the value of the company, which is the stocks that they own, and they add the investors' money all in there, and then they divide that to get the share count. And mutual funds are different than stocks or different than ETFs because they can create shares out of thin air. So if you buy a mutual fund, they just create new shares for you. If you want to buy a stock, there's already existing shares out there. So when we trade from stocks, if you think of it like a business negotiation, in order for you to buy a stock, there has to be someone on the other side willing to sell that same stock, or there has to be availability in the market, and that's where market makers come. Mutual funds are a little bit different because they are their own market makers and they just keep making more shares. And their prices aren't necessarily reflected the same as a stock where it bounces throughout the day. It's just the same all day long. And it's a NAV, so a net asset value, NAV, is the value of the stock. And again, calculated one time at the very end of the day. It makes it, what makes it in index funds are very similar. So you get to invest $100 and own all of the S&P 500 and track that, or own all of the Russell 1000. Where if you were to go buy VOO, which is an ETF, it's at like $600 and so on dollars a share. So you would have to have a full share to own one full share unless you can find partial shares. You'd have to buy the full share and have that full 6 or 7. Where if you just have $100, you put it in a mutual fund, you still get to own all of the S&P 500 or whatever you're tracking. It's made for an everyday investor just to own a full portfolio, and you can own several mutual funds and track several different indices. You can do international markets. You can do a lot of different things.
Are mutual funds like what David Ramsey like swear to buy, bring $200 into them every month? And then from like 20 to 40, your return will be like 1 point.
Well, it depends on how you put it. So a mutual fund is what Dave Ramsey, so he likes 4 mutual funds, aggressive, a growth, and international. What's his fourth one? Maybe a bond fund or something he does, I think. And he does 25% in each is what Dave Ramsey preaches. Okay. It's been a while since I did his stuff. But so that's correlation I'm finding. So you find a really good, he'll say, find a really good mutual fund or a family of funds, and continue to buy them with as much as you can, and you can just put in and they'll make you shares. You don't have to have you don't have to buy a full share because they already have fractional shares basically. You just continue to invest for the life of your investments, if that's 20 or 40 years, whatever it is. And then that's what Dave Ramsey preaches. Yes, that's what a mutual fund is. Similar to an index fund, different than an ETF. So an ETF trades like a stock. A mutual fund only trades once a day at the end of the day, after they calculate the value of the company. So if the market goes down, obviously the company goes down too. So there's it has professional management where stocks are a company and they're driving results for their investors. The mutual fund is similar. It's a company that you're buying. They're driving results for you, so they're rebalancing, it's actively managed, and they're buying, they're selling, they're reporting what they're doing regularly, usually on a quarterly basis to you. And it's just different than a stock, in the fact that, although it's regulated by the SEC, it's not traded the same, where an index fund is very similar to that. And you can trade in and out of those, throughout the day as well, sorry. Stock fund, bond funds, balanced or asset allocation, mutual funds offer all sorts of stuff, so you can have a mix of stocks and bonds in your mutual fund. Really, the company and whoever the mutual fund manager is gets to decide, or team of managers gets to decide, the way, the fund is going to move. So you might own stocks and bonds in an S&P five, something like the S&P 500. It's gonna give you that diversification. So rather than you going out and buying 500 separate stocks, the S&P 500, you just buy one growth fund that tracks the S&P 500, and you're getting that, but you'll also get some diversification in the bond markets, possibly some private equity in there, depending on what their goals and objectives are. So you really want to know what you're investing in. And you stick with a family when you're investing in mutual funds because you earn breaks. So the first 25,000, you'll pay a fee, a little bit higher fee. And then you'll get a break from 25 to 50,000, from 5% maybe to 4%. So as long as you have like 5 mutual funds in the same family, say all American funds or all Franklin funds or all Vanguard, you'll get those breaks in the family. But if you start buying sporadically, you're like, oh, I like Franklin. If you start buying sporadically, you'll continue to pay that 5% until you reach those marks in those individual funds, rather than pooling and combining your funds in the family of funds. So, your management fees go down with more money that you invest. ETFs, again, have very, very low management fees, but again, they're just tracking the S&P 500. So when the S&P 500 rebalances, or they add a new company to the S&P 500 and take someone out, all of the mutual funds and ETFs go and buy and rebalance. So they sell all of stock XYZ, and they go and they rebuy stock ABC to balance it and track the S&P 500, which happens regularly when they add and remove people or companies, not people, but companies from the S&P 500 or the Dow Jones or the NASDAQ, or whatever indice or index they're tracking. What do you guys want to know about mutual funds? Because I feel like I'm just talking. And I can answer questions if I just type them in. I don't know if you can talk to me guys. But if you,
When is mutual funds, is that something better to get into, like, the longer you're in a mutual fund, the more return you're gonna have? So is it better to start investing in mutual funds in our 20s or 30s?
whenever you're ready to start investing, I would say the earlier better. So, mutual funds have very, very specific goals. So your best returns are at the 3, 5, and 10-year mark, and then it kind of levels out. So if you're not gonna hold them for at least 3 years, then I would say don't invest in them. So they're not, I mean, you can invest in them, obviously, but I would say if you come to me and you're like, listen, I want to do this for retirement and I have 20, 30 years to go, then we'll build a really great portfolio of mutual funds. We might add some ETFs or index funds in there. But the objective is to buy and collect shares, just like a stock. You're collecting and you're never selling, just continue to buy. And you weather the market, so you just have to have that iron gut. And if you're investing in stocks, that's the most aggressive thing you can do. You just weather the market and you make really, really good decisions. But you have to understand the companies that you're buying, whether you're buying a stock or an equity or a bond or a mutual fund. You have to understand the company, who's managing them, and why you're buying them, and what their objectives are, and where they're driving your money. Because ultimately, you want your money to grow, I would assume, or do something for you. You're wanting something out of this. So if you're in bonds, that's to protect or hedge against a downward market. If you're in stocks, that's growth during bull markets. So know what the objectives are and continue to put money in. I would say just continue to collect. You have once the money's in there, just consider it gone and just keep buying more and more and more for the next 20 or 30 years. Well, even if it's a stock, and I guess I give good stock tips once a year. I guess I give good stock tips once a year.
Getty.
Oh, that was your choice?
He stopped me with Getty when I mean, it's like 11, but he was like, you know, triples down below like 8, you should buy. And then it hit 58.
And I didn't buy it.
Didn't buy it.
Anyway, so I have a good idea once in a while, I guess. Or if you want to track AI, there are certain ETFs that do that, but there's also mutual funds that give you AI exposure. If you're into cryptocurrency, you're gonna start seeing exposure in mutual funds, ETFs, and index funds that give you crypto exposure with the new laws that are being passed, which is really exciting. It just depends on what your objectives are, what you need to know what you're investing in and why you're investing in that. If you just want to go out and buy a balanced fund, you have to know what and why you're investing in a balanced fund at 18, 19, 20 years old, or why are you doing these things? So actually look at the mutual fund and their description and what they're doing and who the fund manager is and understand. So in my industry, or at least in my office, if we're investing in mutual funds and then the fund managers come out, and a real life story is they started their environmental, social, and corporate governance policies, which is not good for profits. And in business, we're all about profits, and my clients demand profits. This is the reality of the world. So we got rid of those mutual funds because they don't drive profits at the end of the day, and we went to a new fund manager that didn't balance their portfolios off of those philosophies. So I can understand that some people argue for ESG, but on the flip side, the investor needs to know that will drive profits down, or at least growth will not be as high as competing mutual funds that don't use those principles of environmental, social, and corporate governance in their policies. So we switched out of a certain fund company and into some other fund companies when that came. And we've been doing very well, and we'll go back because it looks like they're gonna roll their ESG right back a little bit. So that's exciting. So you have to know who's investing your money, what their principles and their business thoughts are, and why they're investing it. And make sure that that's a good fit for you and what your objectives are. And if your objectives are growth and earning money and making sure those dividends and capital gains stay high, then that's really important. So December is a big year in our industry, a big time of year, a big month, because that's when capital gain distributions come out. So when they do a capital gain distribution in a mutual fund, let's say that it's trading at $10 NAV, and they're going to pay you a 10% capital gain at the end of the year. NAV will drop by $1, which is 10%, so it'll go to $9. They're going to pay you the dollar in your account and buy more shares. And then there's a recovery time for NAV usually, and you can estimate, you can look back on history and say, oh, typically it takes 30, 40, 20, 60 days, I don't know, to recover. But you get those capital gains in a Roth IRA or any 401ks or any investment accounts where taxes are deferred. This is huge because when you get $100,000, $200,000 in there and you're getting 10% on your money at the end of the year, that's 10% additional shares. And then you still have that recovery time and that growth. So even though you had 1,000 shares, now you have 1,100 starting the year out. It's huge, and you spread that across 4 or 5 really great mutual funds. So it's really important and it's okay to move out of one mutual fund family into another if you need to, because their guidance is becoming skewed. So there's ways to manage that, but in retirement accounts especially, it's very special because you can sell and you don't have those capital gain penalties upfront that you would have in a regular self-directed brokerage account or something that's taxable to you. So you want to look at your taxes when they pay you out. So if you're investing in mutual funds in your Robinhood account that's not an IRA or protected by this IRA or ETF or anything that you're investing in, you pay taxes on those capital gains and those dividends. So even if you own a share of GE stock that pays, and actually they don't pay a good dividend anymore, but let's say you own Coca-Cola or something that pays a good dividend, you're going to pay capital gains tax or ordinary income tax on those dividends. And then some international stocks are a little bit differently taxed in the US, but you're gonna pay taxes on those, so it's good to be conscious of that as your money grows. I would say it's not terribly concerning under a certain amount of money. So if you just have a little money in there, don't worry about it. You're gonna get like 20 and 30 cent hits. It's not gonna be huge, so it's not gonna add up, but it'll start to grow quick and then starts to steamroll. And I can't remember the magic number, but your account will start to double every 3 to 5 years at like, I think it's around 283,000. So if you get to that, just off of a super good growth oriented but diversified portfolio, your account will start to double every 3 to 5 years, depending on market conditions. That's why there's a broad range in there, but you want to work with someone or do the research so you can invest your money in a very smart way to double your You wanna start doubling. That's a goal. So you can do it while you're young and get there by the time you're my age, I promise. Yes.
So you said there's a minimal investment that you have to make to like start your mutual fund, right?
Yeah, so each one's
Or what, I don't know, I guess whatever you said. From there, if I put in that $200, I'm invested into that mutual fund. Is there like a specific amount of time that I have in between investments? And do I have to continue to only put 200 in? Or after I make that initial first $200 investment, can I only put $50 in every month?
Sure. Well, again, so there will be a minimum for that. So let's look at this. So, in this American Funds Growth Fund, I just Googled, this is a simple Google search.
Okay,
The initial investment has to be at least $250. Subsequent investments have to be at least $50.
okay,
You can start with $1 million and do $1 million subsequent, but your minimum is 250 to start, so you can go buy the mutual fund for $250. And then to invest again, you could put another 50. So if you're in your, what does everyone invest in? What do you have an investment account on Robinhood? What do you got?
Yeah, I'm in AMD and,
No, what do you got for, who's your,
Oh,
who's your broker?
well, we
Robin
have
Hood?
a simulator
Oh,
for
okay.
Investopedia. The outside.
AMD is good.
Webull.
Okay,
I invest in myself.
perfect. Okay, so Webull, we got Jim the rat.
It's a great answer.
So Webull, you go in Webull, is it an IRA or just a taxable account?
Let me check.
If it's a IRA, you can just trade and there's no capital gain penalties, obviously, but there's day trading laws that you need to be aware of. For mutual funds and Webull, and it's still gonna carry the same. So you put $250 in, that starts your initial investment into whatever this growth fund is, and they're all gonna be different. So you just choose one that you like. And then, let's say you do $25 a week is what you're saving. So once you get $50 in there, you can then buy that growth fund again, because that was the minimum on that American Funds Growth Fund. But they'll each be different. Sometimes in Webull, you can buy partial shares and they'll sell, so you can buy VU for $50. But is what they're doing is they go out and they buy like 100,000 shares of VU at, let's say they bought it last year when it was at $500 or $525 a share or something. And then they're selling it to you for $600 a share, a partial or a fractional share of that equity, because an ETF trades like an equity, so it's considered an actual equity, not a mutual fund. So it's a little bit different. So fractional shares, they become their own market maker. So they're making that $50 or $60. You understand? Webull is making the money. So you'd be better off just going into the actual market and buying them at market value, because you're buying them at a premium when you buy through a broker dealer for fractional shares. The only way you would ever get fractional shares from a stock or an ETF in real life, because stocks and ETFs don't make fractional shares on their own, is through dividends or reinvestments of when you're reinvesting your $5 dividend this month of Coca-Cola back into shares. That's when you start getting fractional shares. So you can own 10,005.92 shares of NVIDIA or AMD only because you're reinvesting dividends. But those companies don't have the ability to give you fractional shares. So the fractional shares is a bit of a scam, I think, in my opinion. If I didn't have the full $600 to make the purchase, I just wouldn't purchase it. That's you can buy a full share of a mutual fund that does the exact same thing. You're not paying that premium. You are paying an expense fee. You're paying those expense ratios, those sales charges. But those are going to the company, whatever mutual fund company, to manage. So they still have managers, they have traders, they have compliance, they have massive buildings that they're paying for. They're an actual company that's doing this, so that's what those sales charges do. And they're ensuring, well, they're not insuring, but their objective is to grow or be a balanced fund and just stay very diversified, or be a bond fund and make sure you're getting that 4 to 6% return. Whatever their objective is, that's the manager's job and that team's job to make sure the mutual fund is tracking that index or hopefully outpacing it. So that's why when you look at mutual funds and you compare them to the S&P 500, you want a good historical track record of outperforming the S&P 500 on your mutual fund, which a lot of people say just buy the S&P 500 like Warren Buffett. It's very passive. You just buy it. There's very low expense ratios. You have Kathy Woods or a fund manager of your ETF that's just rebalancing when those indexes rebalance and are making a play for those. So that's the ETF difference. Does that make sense? Is anyone lost?
I'm very lost, but
Okay.
I've understood
What are you lost on?
a lot of it.
Well, just tell me and I'll explain it to you.
I'm confused at the way you just explained how. I don't even know what you're talking about. Confused.
On the mutual fund or the ETF?
Yeah, what's an ETF?
An exchange traded fund. It's a very passive investment that trades like a stock. So I can buy it right now. And I own one share of it. Literally right now on my phone, I can go into my account and buy it. And I own it just like a stock. A mutual fund only trades once a day at the end of the day, after the market closes, and they calculate NAV. An ETF is actually actively traded on the market by market makers, and they're making the market. So an ETF is tracking. I'm just going to say the S&P 500. It could be any index. It could be a bond. It could be the Russell. I'm saying it's tracking those 500 stocks in the S&P 500 or whatever index. And it's not rebalancing every day. It's not doing these things. It's not making new shares. It's simply tracking those 500 stocks. The only time it's going to change is if the S&P 500 gets reweighted, meaning, let's say NVIDIA is in the S&P 500. And NVIDIA is a massive $5 trillion company. I think they just hit $5 trillion in carbon. And so they have to rebalance the S&P 500 because that's now the number one. And so they only want to have X amount in that ETF in NVIDIA. So let's call it 0.5% in that one equity. So they'll rebalance it. But let's say XYZ stock gets kicked out of the S&P 500 and they make room for the new company, ABC stock coming in. So now the ETF, the exchange traded fund, those managers have to sell all of XYZ and they have to buy all of ABC stock. Does that make sense? So they sell one company because it's no longer part of the index and they buy the new company. So now they've rebalanced again. Where a mutual fund has the mutual fund companies have a little bit more discretion in their trading. And they're rebalancing and they're looking at these things daily. They're not trading them daily, but they're rebalancing, they're making new shares. And they might overweight in NVIDIA because NVIDIA is growing right now. It's huge. It's a $5 trillion company. It's hot and it's fun and it's AI and then Palantir and AMD. And there's a lot of really great things. So they're overweighted in those areas because they're trying to outperform the S&P 500 and outperform those ETFs. So that's why you pay those expense fees and those sales charges is because you're buying a team to drive results. In this instance, it's growth in those results. Does that make more sense?
Yeah, so basically every company is in competition of what the S&P 500 is doing, and their goal is to perform higher than that.
If their goal is to track the S&P 500, it could be a bond fund. So then we have American Funds Bond Fund that tracks bonds. And then we could also look at Vanguard ETF that tracks bonds. But the mutual fund is trying to outpace the bond market or the Barclays, it'd be like a Barclays index. So whatever they want to outperform the index.
So are you suggesting like, obviously it's higher risk, higher reward. Are you suggesting that it would be maybe worth more of your investment to invest in a singular, like to invest just in NVIDIA since it's such a hot company and they're doing better than the S&P 500? Or would it be better to just be a little bit more passive and only invest in the S&P 500 with my actual money?
I'm not making any suggestions there. It's what I'm telling you is NVIDIA has just hit $5 trillion, which is massive, and it's trading at like $200 a share, maybe 197. I don't know, it's right around there. So if you want to buy an individual equity, and let's say you buy that, it's $200. The most money you can lose is $200. If you buy American growth funds and you put $200 into it, even though the minimum is $250, we're just using this for example, and you put $200 into it, part of your $200 is going to own NVIDIA, but it's also going to own like 500 or 1,000 other investments, not 1,000, but 500 other investments that they manage.
Okay.
So if NVIDIA goes to zero, your $200 might be worth $195.
Okay.
Because you in the mutual fund, you own all of it. Same with an ETF, you own a whole basket of stocks. And NVIDIA might be one of them.
Mhm.
So if Nvidia fails and goes to zero, you don't lose everything, you just lose a little bit. And that's called diversification. So you can go out and buy 500 separate stocks and create your own ETF in your portfolio. You can do this. In fact, during COVID, we were all playing just amongst each other as advisors, making the COVID like portfolios basically. So we had toilet paper and water, like we had stuff like this, because toilet paper was so scarce. So we bought Procter & Gamble, we bought these things, making these things to track those markets, or Eli Lilly and the pharmaceuticals, like these are the things you wanted to track during that time. And it was just a fun exercise for all of us, as financial advisors. So you can create an index or you can create, to track anything. We could track, just the banking market, we could track just retail markets, we could track anything we want. And you can build a portfolio around that and you can have your own ETF basically doing that in your own portfolio, or you can just go out and buy one that's already made, so.
So an ETF is just like a bunch of stocks that you can buy?
No, an
You can, like-
ETF is a company, like VOO, the symbol VOO is an ETF, it's the Vanguard S&P 500. You own all 500 stocks in the S&P 500 when you buy that ETF.
You can basically just make your own if you go and just buy a bunch of different stocks.
Or you can make, yeah, we can make one right now today, what do you wanna track?
Yeah, you did this a couple years ago,
Yeah, we did.
that was pretty effective.
We can actually make an ETF today or a mutual fund today. The difference between the ETF today is it's very passive. So we're gonna go out and buy, say, 10 different stocks. And we only wanna track AI. We could make that, right? And we gotta buy 8 to 10 companies, individual stocks, and we build that index. And that's now the index. And now we have an ETF. Now we want to build a mutual fund and we take those 8 to 10 stocks, right? And then in those 8 to 10 stocks, let's say it's equal amongst all of them. So each one of them, let's just say 10 for the purpose of mathematics, right? We own 10% of each of them. So we have $1,000 in there and each one of them, we buy $100 worth of those 10 stocks. But then you want to make a mutual fund. And and your mutual fund is going to outperform our ETF. So you're going to say, well, I'm going to buy $200 of NVIDIA, $50 of Palantir, $50 of AMD, $50 of Oracle, $300 of whatever this next one, RGTI Quantum Computing Company. See what, so he's trying to outperform my index that I just created, which was AI.
Okay.
And he might not succeed and be a very unsuccessful mutual fund. I don't know. It depends on the fund manager and the team behind them and how smart they are. So that's why when you look at mutual fund, you want to look at past performance to make sure that they've at least paced, if not outperformed, whatever index they're tracking. If you're looking at the actual S&P 500 ETF, then you're just going to track the actual S&P 500. So if you just look at what the S&P 500 is at today, it's like $6,000. You're just literally tracking that in form of an ETF.
So an ETF almost just sounds like an investment portfolio. Like
Sure.
what would be the difference between just an investment portfolio and actually starting an ETF? Besides the fact that you're putting your money into the ETF and it gets spread.
Yep.
But
So if you as
What
an
would be the
investor,
rewards for
sure, if you as an investor buy just the S&P 500, which is VOO, or there's other,
Yeah, yeah.
SPY is one, there's others. You have a portfolio manager at the ETF that is gonna automatically rebalance it. You just put your money in, set it, forget it, that's it. And they're doing the rest, and they're doing it for a very, very little expense ratio. So they're doing it for like 0.01%. So they're doing it for very, very little. Because they're not doing a lot of work. They just buy it. Once in a while, they rebalance it when needed. Other than that, you're just buying it. They take very, very little. If you're looking at a mutual fund, you can put $250 in and have the same thing, but they're gonna try to outperform the S&P 500.
okay,
So you're gonna get a little bit different management, and they're gonna be a little bit more active in that mutual fund than passive like an ETF. Does that make sense?
Yes.
And then if you want to be a fund manager someday of your own, or even just, and you wanna create your own index, I mean, anyone can do this, right on their Robinhood or Webull or whatever account. You can make your own index to track whatever you want. So you could make your own AI index, or you can go out and buy an AI ETF that's focused on that index or that industry. Are we following okay? Can't see them, so I don't know if they're on. So, I mean, does that make sense, guys? You could do one that does, just, fitness, if you're into fitness. I mean, I don't know what you're into, so you just, I mean, you could do whatever you want, you can follow the car industry. So GM is not gonna have Apple CarPlay anymore, that's interesting. Or so they're gonna get rid of all Apple, so, you can't have your phone on the screen. Oh, they just announced that.
What was, why?
I don't like it though. I don't like.
You drive a GM?
I have
GM
Ford.
different one, yeah.
Ford.
So what was your recommendation for a young college student who wants to get into investment? Where would my money be best?
Just buy the S&P 500.
Okay.
Really, over like the American Growth Fund or something?
I mean, the growth fund is good too. I mean, it depends on if it's in your retirement account. Buy some good mutual funds and just continue to buy them. If you're gonna continue, if you're gonna buy the ETF, then you just have to systematically buy 1 share a month, 2 shares a month, whatever you can afford. So if you have $1,000 a month you're investing, you can buy 1 share a month, but the next, after month 3, you'll buy 1 share month 1, 1 share month 2, and then you'll have enough in reserve to buy 2 shares month 3. Or you can even take your whatever, $1,000, so 600 for say VU or SPY. And then the other 400 go buy some individual equity that you like, AMD, Nvidia, Palantir, whatever it is. But you just collect these things, don't sell them. And buy really, really good companies that you understand and you love, and you know, and you believe in, and don't sell them, even when times get tough, buy more. And then the mutual funds though will give you diversification similar to the ETFs, just traded a little bit differently. So if you're not as aggressive, then go into a really good mutual fund portfolio, and you're gonna do very well for yourself regardless of what you do, as long as you just stay consistent and keep going. And then mutual funds are made just for the everyday man and lady, or everyday worker, that you just $250 gets you in. And $50 minimum gets you continued support. So just keep investing. And as you grow in your career, keep investing more and more. And get to that 20 and 30% mark of your income going into your portfolio that you built when you were young. And then rebalance it as you get older, and it gets out of balance, and your objectives change. So you have a family, you have a house, so you want to get a little less aggressive. Or you're approaching retirement, so you want to get a lot less aggressive and go cash or heavy. So those are things you want to consider in working with mutual funds, and ETFs or stocks. And stocks, you can make a lot of money in stocks. And you can make a lot of money doing all of this. But if you want to do an actual investment portfolio, then you buy mutual funds, ETFs, you get some diversification. If you're going to trade, then you do stocks. But you should have an investment portfolio backing you up. And then if you want to trade some, you do that for fun. I'm not a big trader, I'm more of a buyer. We just buy and hold and.
Yeah, well, and that's definitely like what I would do, I'd be too scared to be trading stuff, man, that's for the Wolf of Wall
And
Street.
then, if you're trading, there's SEC and FINRA laws, which guide me, but they also guide individual investors, so you can't do, you only do so many trades per week, so. When you talk to day traders, they're not actually trading the stock, they're trading options, so they're playing in the options, which I would caution anyone against, because you're borrowing money. To buy options, basically, so you're playing with margin unless you're covered. And you fully pay for those options, so then you're paying a premium though for those options, but that's super advanced, so be careful doing that and don't do anything silly. Yeah, it's pretty simple. What other questions? Let me see what else we got that I didn't get.
So the mutual funds, you say, because I've always wondered this myself, I mean, I know they're actively managed. I mean, how actively are they managed? I mean,
Yeah,
is
they're active.
it's like daily?
Oh, they rebalance,
All day.
well, they give you a NAV every day.
Yeah, but like in terms
Um,
of moving in and out, rebalancing the fund itself, I
Um,
mean, are they?
minimum quarterly. But are they actively daily trading stocks? Not unless something's happening or they're forecasting or they're going through something.
Right.
So it's a passive active. They're considered active, because they're giving you that NAV every day at the end of the day. They're creating new shares out of thin air. So if I want to go out and buy $100,000 worth of that mutual fund, there's only 10 billion shares out there. They'll just go create another 100,000 shares for me to buy it. They can just create them out of thin air. If I want to go buy 100,000 shares of NVIDIA, I have to find someone or a pool of people to sell me 100,000 shares. It's much different. If I want to go out and buy 100,000 shares of S&P 500 ETF, I have to go out into the market and find someone to sell me these. So that's what they're doing in New York City, at Wall Street, in the New York Stock Exchange. Those people on the floor screaming, they're making markets. They're called market makers. So they're finding people buying and selling, and so they buy at the ask price, say it's the ask is $600. And the bid is the sell price at $558, or like, it's gonna be really close, like $559.50. It's gonna be very close, so you can buy it at 600, but you can sell it at $559.98 or something. It's gonna be within pennies, or it's gonna be within some sense. That way you're not just buying and selling. So you take a 2-cent loss or something on your purchase. Or mutual funds, if you want to buy it at NAV, it's at $59. They'll recalculate it at the end of the day, and then you'll buy it and they'll create new shares. But they're the only ones that have that ability just to create shares out of thin air, where stocks and ETFs don't have that ability to create those shares. You have to go out into the market and create them. That's why fractional shares are a little bit different in your accounts, and it's changing the market. Because everyone can just take $100 and go buy VU. And you have how many shares would you have? You'd have like 0.15 shares or something. You'd have a fraction of a share. But those don't actually exist in real life, because fractional equities don't exist. Those were a company goes out and buys a huge block of shares and then sells them back to you for a premium. So if I buy them at $550 and I'm selling them to you at $600, I'm making $50 per share on those trades. That's what's happening. And I'm not saying that's exaggerated how much they're making, but it's very possible, because they're just buying a whole bunch of those and then selling them back to you fractionally, because those don't actually exist. Fractional shares aren't real. They're only real in certain account types. So like, I can't sell you a fractional share.
Our textbook talks about, I think they're called closed-end funds or something, where where they
Oh,
don't make
sure.
new ones, right? They just make a set amount. Is that still?
No,
a thing?
so closed-end funds versus open. So an open-end fund is everything I've talked about today. Closed-end is we put $100,000 in, and it's closed until a certain date or a certain timeline where it's opened up again, where you're allowed to buy more or sell and get out. So you have to hold those for a certain amount of time. So they might not be making more shares, but they're closed because there's a holding period where you have to hold them. And then they open it up for new buyers to buy into their fund during a certain time of year. And during that exact same time, if you're already an owner of it, you can get out or exit the position too. But when you buy those funds, you know going into them that you're in it for X amount of time. It could be a quarterly, if they open it up. It could be every 6 months they open it up, or just every year or 5 years. Like a lot of REITs, so real estate investment trusts, are this way, where your money gets tied up for an amount of time, and you can only get into them at a certain time and out of them a certain time. And that's how they develop these massive shopping malls and stuff through REITs and other development projects. But your money is actually tied up in there for a certain amount of time, so you can only get in and out during a certain amount of time on closed-end funds or REITs and different investments like that. There's some other account types like that out there. So closed-end funds, I don't sell a lot or suggest that they exist. I don't do a lot in the REIT space either. There is some good, there's some good stuff out there, but
What do you think about the big short guys? He just shorted $1 billion.
I was reading more about that. So $1 billion on Palantir and like 100 or 200 million on Nvidia.
Shorting it.
Yeah, well, he's buying puts. I don't know if he's truly naked. Call it, like, is it a true short? I don't know. He hasn't disclosed exactly what he's doing. So Michael Burry, so he's shorting AI, saying it's in a bubble. And the reason he's saying that is because Nvidia, it will be like, we'll sell Meta 10,000 of our chips or whatever they are, AI. And then Meta's like, okay, and we'll pay those for you at some point. So they're showing, we'll sell those to you in 2030. Right? So Nvidia's like, we'll sell you 10,000 of these supercomputing chips in 2030. And then they're like, okay, and they're reflecting that sell on today's balance sheet. So he's saying they're hyperinflating or they're cooking the books a little bit. It's an aggressive way of accounting. He's calling it aggressive accounting. But it's very incestuous because there's like 10 or 12 companies in this orbit that are all, and then Meta's like, well, I'll sell it to you and I'll do this and this and this, and it's just trading money from balance sheet to balance sheet. And aggressive accounting is what they're calling it. That's the new term today anyway. And that's what they're saying is happening. So he's shorting it, saying that AI is in a bubble. And he's betting against AI is what he's saying.
This is the housing prices.
What does that even mean though, betting against AI?
Sure. So in options, you can play options and you're either a bear, meaning the market is going up, or you're a bull. So if we have AI, we have a lot of companies in AI. They did this in GameStop. Did you follow GameStop? Diamond
I
Hands?
kind of know what it is.
Okay, so if short sellers and hedge funds were betting against GameStop, just like Michael Burry is betting against AI, saying AI is in a bubble and it's going to go down. He thinks it's going to go down in 2026 and 2027 is what the report, well, what his statement on Twitter, he goes under Cassandra or something on Twitter. He's saying it's gonna go down in 2026 by 30%, some of his estimates, he thinks. Is what, and he's gonna release more information on November 25th about his positions, but that's fine. So he is against it, saying he thinks it's going to go down, so he bought options, saying put options, I think he bought puts, so I don't think they're naked though. I don't think he did it like. He bought the right to sell at a certain point, if the stock goes down, so it's trading at $200, so he went and put $1 billion in, saying, I'll bet you. Next year, this time, it goes to $100 a share, what's $140 a share. So he bought, and he has the right to sell it at $200 a share, even though it's trading $140 a share. So he thinks it's going to go down and he's betting on that. And in a year's time, or any time between there, he has a right to sell those shares for $200 a share, even if the stock price is worth $140 a share. And if he did a true naked, then he might have an obligation to sell them at $200 a share, which is very, very, be very careful with playing with margin. You borrow money to do it, but you have an obligation if you buy the right option. And if the stock goes up, you still have an obligation to sell at $200 a share. So then I would have the right to buy them at $200 a share, and you have an obligation to sell them to me. So it's a little bit different. There's rights and obligations in options trading.
But even shorting a stock, are you expecting it to go back up? So even if AI has this short crash, we could expect it to probably go back up even after 26, 27, if it does kind of crash.
I think, well, I don't know. I'm gonna say, I think AI is going.
Right, that's what I. that's
So I
what-
mean, there's everyone has a different school of thought. So if you're following AI and this is your thing, and you're a bear or you're a bull, so you're bullish on AI, then you think it's gonna go up and we're not in a bubble. So I invest in AI. In fact, I was just telling you, I'm gonna be a partner in a new AI company, we're buying into, which is exciting, in a private equity deal. Cause I'm bullish in AI. Other people are bearish, and that's their school of thought, and that's okay, but he's betting against it. And he might lose money and he might make money. He's made a lot of money being this way in the past, billions. Will it recover? Some companies do, some companies don't, I don't know. So you have to know the company, what you're investing in, why you're investing in it, and you have to understand it.
It's almost like he's maybe not so bearish on AI that he is on the system that all these companies are using to funnel the money around and and more the accounting, so like, you know what I mean, like.
Which is against the company.
Which is, yeah, but the industry itself, right? How can you be bullish or bearish on AI? I mean, it's like.
I don't know, $1 billion bet against Palantir, I think is a bad bet.
Oh, it's a terrible bet.
That's my opinion. But I've been with Palantir since they IPO'd at $10.
Palantir, he
Yeah.
told me about Palantir 3 years ago and it was like $16 a
Yeah,
share.
and it was like November this
It's
time, like,
185 right now.
like November this time. Like 3 or 4 years ago, I think they IPO'd at $10 a share and we bought a ton of it and then we bought more. And then it went down and some people sold and I was like, and the ones that held are very happy today. It's a very,
Last,
very, very.
last year alone was like a 200% year, right?
It's been a good year for a lot of my clients. I don't know, it's been a good year.
Actually, more than two. last year.
It's at like $200 a share today, Palantir is, and we got it at 10, I wish I would have got, forget EC. Quantum computing, post-quantum, we follow, we're in a technological age. And you have to understand, there's geopolitical tensions, overseas with China and China advancing in these technologies. And then you need to understand what the US government's doing and how they're funding and what they're doing. It's a very, very, hard thing. So if you don't want to spend the time doing that, the moral of this is to pick individual stocks. Then you buy a mutual fund and those people and those managers will do that for you. And that's their job. And you just get to go to work and do your job, in business, finance, whatever you're going to do. You invest your $200, $300, $400, $500 a week, whatever it is you're investing into these $1,000 a week, you invest unlimited amounts of monies into these. So you invest your money in, they manage it. And you pick the mutual fund or the ETF that fits your objective, and they all do different things. Some of them are bond or cash oriented, so they're not going to grow. Some of them are growth oriented, some of them are balanced or hybrid, so you're gonna get a mix of bonds and stocks and you're gonna have these different objectives. That's what a mutual fund is. So you don't have to go out and do that research and sit in front of a computer screen all day and read about all this and understand what's happening in China and Taiwan or India. Or know that those markets are becoming oversaturated in AI and it's moving to Bogota. I was blown away by this. I just learned. So Bogota, Colombia is picking up in developing AI for really cheap, and that's what people are moving their operations to do. So this is crazy to learn about just this week, see? And Israel's gonna start picking up in AI space, which is exciting. There's a lot of exciting things happening in AI. So yeah, but if you don't want to track that, then you buy a mutual fund and you let someone else track it for you, and then you just invest your money and then you find out what their objectives are.
AI is the reason I'm investing in Google right now.
Yeah, Google, it does a ton of AI, Meta does a ton of AI, and so I don't know which AI you use, Chat GPT or which one?
Like use
Yeah, which,
Microsoft?
you use the Microsoft Copilot?
Yeah.
Is that, do you have to pay a subscription?
No, it's just a part of the computer.
Okay,
That's how it is with a lot of these anymore. It's just part of the program.
oh, okay.
Like even, like there's an online, presentation platform called Canva. It has its own AI.
No, I saw that.
Oh,
Its own
Canva
AI
is
thing,
a
so
big-
it could like make you an entire presentation by itself.
Cool, so Canva's cool, I don't know if you can buy Canva, but Canva's cool, I use Canva for graphic design and all that. Perplexity's good, I don't know about Microsoft stuff, but yeah, see if you like that, then you can buy Microsoft.
Yeah,
But Microsoft is then, you need to understand what Microsoft is investing in and buying, or are they buying Chat GPT, what are they buying in these large language models and understand? Or small language models, or you need to actually understand these things. If you're going to invest in it, I would assume, so if you're investing in GameStop, you have a really good understanding of what GameStop is. And why you're investing in it. I mean, if you don't, then that's how the Roaring Kitty made so much money, he understood it was over shorted, and they shorted it more shares than there were available, and stocks can't just create more shares. So he went in and bought all the calls on it, options, like $50,000, and ran it up to, I think, 20 or 80 million or something. But he put everything he had into calls, so he had a right to buy those shares. But they didn't exist, so they just kept going up, and that's what he was trying to run up. So he had a really deep understanding, deep value of what that value stock was doing. So if you're going to buy these companies like Microsoft, you need to understand everything they're doing, is what I'm saying. Or buy a mutual fund, and those fund managers already understand that, or an ETF because it's part of an index. Does that make sense?
yeah,
Okay, so. Yeah. No, okay. And just for everyone at home, you missed cookies and muffins.
Yeah.
I'm just
Thanks
gonna
for the recorded. People hear that too.
continue to say that.
First of other industries, since we have you here, let's do it like 15 minutes. What do you think, as an advisor, outside of AI, I mean, that's obviously the big one, everybody's aware of that, but what are some other industries you see?
So I'm hot on natural gas. So I think solar is becoming a fad and it's gonna start going away. It'll go heavy into nuclear, natural gas and coal. They're releasing coal permits. Wind, they'll start getting, less subsidies, and when those subsidies aren't coming in, they're gonna stop developing them, but they will continue natural gas. They're gonna continue to mine coal, obviously, they're releasing like 3,500 more acres, as much as one, and then, nuclear, it will be up and coming, but that's gonna take a long time to get there. When we look at nuclear, so nuclear is actually fascinating to me because they're gonna put every single military base on nuclear. And the military's been using nuclear in their subs since the 50s, so. All the bases will come off the grid and go strictly nuclear, so. Close to home here, we had Radiant Technologies that almost came here, it went to Tennessee instead, which they built these
We're not gonna
micro.
build the power plant in Kemmer anymore?
Kimmer's already being built, yes.
Oh,
I'm saying Radiant Technologies was going to be built here outside of Casper,
oh,
but they moved to Tennessee and didn't choose Casper, they chose Tennessee, but that's political stuff, so.
But didn't we not accept them more?
It's political, okay, so, they chose Tennessee. I'm being recorded.
Alright.
They chose Tennessee, and that's okay, but they make micro reactors, so is what they do is, Kimmer produces, nuclear waste, and let's just say it's a metric ton of waste. And they're only 70% efficient, so, 30% of that is waste, so they take that waste and they send it to somewhere like Radiant Technologies. And Radiant Technologies takes it and breaks it down and makes micro reactors, and they make new cores from that waste. And those reactors are 97% efficient, so we take 30% waste and turn it into 3% waste. But we take those, we make the new cores, and we ship them out to all these military bases or these AI data centers are each gonna have their own because they're gonna start producing their own power. So when we look at nuclear technology over, especially the next 10, 15, if you wanna play a long game, that might be a good one to start researching. They take these and then we break that 30% waste down to 3% or less because they're 97% efficient, these micro reactors, using the waste from the larger nuclear facilities that are only 70% efficient. The problem they're encountering is what do you do with the nuclear waste? And where do we store it? This is the debate that's happening right now. So you just want to track, I think, that index of nuclear technology because it's fascinating to me. But natural gas is definitely up and coming, and I would definitely support natural gas investments. Coal, obviously, in the traditional energy sense and industries are all firing on all cylinders right now, but nuclear is coming up. They're gonna stop subsidizing. In fact, I think they shut down like the Death Valley or some of the solar stuff in that area, southern California, southern Nevada area, right in there. So those solar plants are closing. And then wind is just gonna stop getting subsidized, so there's no money in it, there's no profit in it without those subsidies. So they just won't get those anymore, and then they're gonna have to search a new way forward for these technologies, and I think it's going to be nuclear and natural gas.
what about a real rare earth mineral?
Yeah.
Can you invest in those specifically?
Not yet, but I watch them closely.
Yeah, that's one that I definitely want to get into.
There's a lot of different good stuff, so you have to understand again what they're mining, why they're mining it,
Yeah,
but
cobalt, nickel.
cobalt, nickel, yeah, and then.
The stage in which they're at is a big one, because
uh,
they can get stuck in red tape, like that one up by Upton, it's just been in red tape for like 3 years.
Yep,
They can't get any progress.
but again, that's the political or geopolitical risk that you find in the markets. So the markets only have certain types of risk, intrinsic risk, geopolitical is one of them. These red tape things are a risk in the market that as an investor, you have to absorb that risk. And either have a long game or have a plan for it, or start investing after they get going. So you can be an early investor, or you can invest once they get going and have everything up and running. But those are decisions each individual investor or their manager needs to make decisions for. Yeah, rare earth minerals, amazing. So antimony, I've learned a lot about rare earth minerals in the past 6 months, so it's very exciting.
I'm in antimony right
Oh,
now.
are you? All right. They can use that in Department of Defense as fire retardants on all their fighter jets.
And they've got defense contracts.
I know. I know. There's some really exciting things. And then Roomba, the iRobot stock, I actually did my puts on this. So I will tell you, I did do options. So we're doing. It's Roomba, I think that company's done for, because they have all the patents. But the problem is Temu just steals and just makes their own Roomba. So where you can buy it for $300 at Sam's Club, you can buy it on Temu for like $30 because they just take that intellectual property, replicate it, shove it out to the market, and there's nothing, they've spent all their capital in litigation and lost every one of them because their patents just didn't hold up in court. So,
What? That's
but
great.
again, that's
China.
that's part of the risk investors take in these individual companies. So if you own all of the index for these robotics, and you can buy indexes in robotics, then let's say you put $10,000 into iRobot and it's worth, I think it's trading at like $2 a share right now, something like that, and it was at like 30. If you were in the index, only you wouldn't be affected but by like 0.1% because you also own like 50 or 100 other robotic companies. So the diversification helps spreading your money out across them, and the easiest way to do that is through an ETF or a mutual fund. But if you're going to invest in individual stocks, you risk everything. And Enron is the greatest example of this, which is before all of your times, I assume. I'm just making assumptions here, but
I've talked about. the
Enron
case a
will,
little bit.
you can put $1 billion into one company, and the most you can lose is 1 billion, because if it goes to zero, it's worthless. And you lost everything you put into it. They can't come to you and be like, you owe me more money. They can't do that. So. They literally can't do it. So you just lose everything. But if you put your money into a mutual fund or an ETF that tracks the energy sector, because they were an energy company, then you're buying a whole basket of stocks, a portfolio, say, with that. And if one company fails, the other 99 or however many are in your basket or portfolio are still going. So it doesn't affect you as greatly as one company would. So the risk with one individual company is the greatest risk in your portfolio. So they're the most aggressive thing to invest in. I'm getting dry throat, sorry. What other questions? I can talk a lot.
What's your education background and what got you into
I
this?
was here at Casper College, and I got a theater degree, and then I went to UW. I got English and history to go to law school. Did not go. Sold real estate because I was sick of school, and then I got recruited into finance. And I've been very successful. Numbers make sense. Real estate is different because I was really successful at commercial real estate. Residential was emotional. Numbers are unemotional. There's no emotion in these things because it either makes sense or it doesn't make sense to invest your money, and it's either going to return money. So every dollar you put out needs to bring dollars back to you. It's very unemotional, and you weather the storms. Or if you look at a house and you're gonna buy a house or you go apartment shopping, you're like, oh, I don't like this color and stuff, it gets emotional and there's too many. It's just not how my brain works. And that's, I think what's made me so successful here is I just can look at it and either it makes sense or it doesn't make sense. That's why ESG doesn't make sense to me. Because it's bottom, the balance sheet has to return money. And if you're making decisions based off of environmental, social, or corporate governance rules, that's not going to return money to your investors, which is me and my clients. Therefore, I don't have a use for you, so I will go buy something else. So if I want to buy Tesla, I'll just go buy Tesla, and I wouldn't bet against Elon Musk. His new pay is $1 trillion. His new pay package is $1 trillion, so Elon made a big comeback. So if I want to go buy his companies, I'll go buy his companies. But it will not be for any reason other than I need my investors to make money, and they're selling at a discount, and I see an opportunity for my clients to make money. So that's how we make the decision: is how am I going to make money today for my clients tomorrow, and that's the name of the game. And mutual funds are a great way to do that, especially if you're younger and you're starting out. Same with ETFs, because you just start hoarding money into these investment vehicles. And you just start buying and doing this, and you don't have to think about it. You just set your bank accounts up so it automatically goes into your account, and then once a month on the 15th or whatever day is your favorite day, you click buy and it's done. You don't even have to think about it, and you're in a really, really great portfolio. It's managed by a really great company, and you did research or have someone like me working with you to make sure that those companies are performing, or if you need to exit one of them and get into something else, you can. So, yeah, but that's my history. Right here at Casper College. It all started here.
Yeah.
Right here at Casper College. What other questions? Nothing? Right.
All in the yard?
I don't know, I've been started, but if you go to Omnibus Financial, I can get you one out of my truck. I'll get you one, it's okay. Sure. I don't know for the backseat, I think it's more. Yeah, that's easy, or Omnibus Financial.com, all my information's there, you can look me up, and my office is just right on Davis Street.
Are you still looking for interns at all?
Yes, we hire interns, one lucky person gets to put up with me while I pay for their college.
Yeah,
Isn't that
about every year I've had someone from this class.
Last year I had two, I think one came from UW. I
Yeah,
only pay for one person's tuition because. It starts to, like, I'm. The one guy's graduating, so I still have like three on tuition, you get it. It starts to add up, so,
What do you do for you as an intern?
you come into the office, it depends. Whatever I want you, whatever I want you to do. It's not, listen, it was a shocking surprise to some people because, this isn't like Wolf of Wall Street.
No, I get
I
it.
have a couple hundred clients, it fluctuates. It's not a store, there, people aren't storming in the doors, it's not busy, we're building portfolios once in a while, we're rebalancing, we're in meetings. Owen is, full-time with me now, but, I don't know, we're doing whatever it takes, I mean, we go to parades, we travel the state. I don't know if Owen was with me, I don't know, he'll be in Denver with me for some commercials we're filming, we're doing all sorts of stuff, I don't know. You just do anything and everything, but you get to like
The benefits.
learn, I guess, I don't know.
I loved it.
I hope he did. I felt bad for him because he came to me and was like, listen, this isn't what I expected. And I'm like, well. We're not trading stocks daily. If that's what you think I'm doing is trading stocks and it's this high stress thing. I've done that. I'm not doing it again. My life is stressful enough without stock trading. I promise you that. And you'll feel every ounce of stress in my life when you're in my office, but,
I mean, you still got a full head of hair. I'm doing pretty good.
we're just getting haircuts today. And I'm turning gray. There's some sparkles of gray coming through me. It's very exciting.
No, I think Matt got the grind, but like, the grind's terrible at first, but after a while you appreciate the grind, right? 'Cause that's what you do, you start to learn
Yeah.
the game through the grind, like, that's how I envision it. I talk to him 2 or 3 days a week.
Oh, yeah, okay. And he's at UW now, so I just talked to him, I think, last night or something.
Okay, yeah, I haven't talked to him since.
Oh, there you go.
All summer, we were talking all the time, and I think he liked it.
I hope you liked it. We had some good stuff going. We were part of the TikTok acquisition for Wyoming, and then we were on some rare earth stuff that he was in. He got us in some very high level phone calls with some very high level people, and got introduced around to them. And then I put him on an AI development because we're gonna develop an AI together. So he'll be part of that.
Matt?
Yeah.
Oh, he's still with you then a little bit, huh?
Yeah, he'll be part of that development, so he's gonna work through that hopefully. And you never know what an opportunity brings, so. It's interesting, so if you're into that, I don't know. And then I think Scott was a coder, so he just coded, we made a cryptocurrency, we made a stable token this summer. We're just waiting for the digital asset organization and white papers to get done with the legal stuff. So that was exciting. I don't know, it was exciting for me. I don't know how exciting it was. I mean, he sat in the back office and typed and tried to ask me questions, but it was way over my head, so I just led the charge and paid the bills, and then they developed, and Matt was right there. The AI development will be very exciting, I think. And then it's next year will be crazy. Next year will be nuts. Any other questions? Anything else? On investing, and any investment questions or business finance or any questions?
You got him here. A pretty good resource.
I got his business card. You got it. You got any other questions?
Alright.
And you guys missed out on all of your cookies. Do you guys actually want these or no?
That's what, I ate them all.
I'm just gonna leave here. Do you have more glasses in here?
Not in here, right? I mean, I can take him down to the
Okay.
student lounge or something.
There we go. I don't want to.
Okay.
Thank you
thanks.
guys. I appreciate you. Thank you guys at home. Bye. All of you. You didn't ask any questions.
Yeah.
Do you want some food? There's food in here.
There's cookies and muffins.
Especially these.
Personal finance.
free food, no?
No, I'm good, I'm good. All right, stop.
Thanks, guys, enjoyed it. Enjoy your